For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
What trading can we do if we have this thing and we think that, hey, the market's going to get really volatile, or it is really volatile? So one of the things I did, and you guys have been to my live events, you've seen me do this before. I literally, this morning, I made up a trading strategy. And my thought is that, hey, it's non-subjective, right? This is completely non-subjective. I'm pretty much, it's completely non-subjective from a directional standpoint. But when I'm going to do a trading strategy, right? So one of the things I want to do is I want to get a base for, if I just kind of make up some rule set, I want to get a base for how it does. Now, I only get a 6-month period because I made this up this morning and I only had time to backtest 6 months. But I have this base strategy, and from if I'm doing this as a new trader who doesn't understand technicals, who doesn't understand price movement probabilities, who doesn't understand applied volatility, I'm looking for, I never want to lose. I want to win as often as possible, and I can't have any big losses during this period. And over my time period I test, I have to make, 20% or 40% or 50% annual return on the time period I tested. When I test a strategy, I'm like, hey, if this thing breaks even, that's wonderful news, right? So any strategy that I might backtest, and if I backtest it properly and it breaks even, for me, that's wonderful news, because I know that I understand price movement. I know that I understand applied volatility movement. I understand that I know how that affects the positions. And I understand what I'm doing. And if I have a trading strategy that breaks even over time, then I know I can make a killer profit with that strategy, because with that basic understanding, that's enough to put the odds and the probabilities in my favor, and we're good to go. So my thought being, if I'm going to test a market that I think is going to be volatile, what type of trading strategy can I put on that is going to probably make money in these more volatile conditions? And there's really not much. If you're going to get a really big price move and you don't know which direction it's going to be in, there's really not much better than just like a strangle or a straddle. I mean, I could do this at the money. I don't like at the money because, I get an awful lot of risk in the trade, but I can go out of the money with my call and my put, and I can put this on. And what I'm doing here is I said, hey, why don't we just go around 6 days to expiration? Actually, I said around 7, right? So I'm trying to get like 7 days to expiration. We're going to enter this straddle. We're going to do it at, initially my thought was this is going to run into some challenges as we go along. Initially, my thought was that I'm going to use just one outside of a 1 standard deviation. And like I said, I just made these up out of my head. We'll go up outside 1 standard deviation. In this market, it's like $5 and $6. They're relatively even. We'll just do that, and I'm willing to stay in it for like 3 days, 4 days maybe. And my objective here is, if I get a significant profit in either option, I'm going to close it. I'm going to basically reopen something else. And I'm going to leave the other option there. If it doesn't have any money in it, maybe it's going to make money if the market reverses, right? So it's pretty simple. One of the things that I love about trading this way versus the way we normally trade, where we would maybe sell this option and sell that option, right? And then maybe buy another option to cover it, or a condor. What's different about this is the risk-reward ratio. If I sold this option and sold this option, like if I did a new trade, and I didn't do anything to this for the duration of trade, this probably has a higher probability of winning than my others, than if I went long there. It depends on how I manage it too, by the way, but it probably has a higher probability of winning. But look at this. I can only make, and people will do this all day long, and I don't always understand it, but I can only make $1,000. And realistically, if I have some sort of a major market event, $10,000, $15,000, $20,000 drawdown probably wouldn't be out of the question here. So my win rate has to be spectacularly high to cover that one time where I take that relatively large loss. To help offset that, I can say, okay, I'm going to go into a condor. So, now I have the credit, which is really cool. And again, if I did nothing, I'd probably win this more than I'd lose it. But what's my best possible win is like $600. My loss is $2,400. My losses are 4 times my win. I have to win this a high percentage of the time in order to have a break-even strategy, right? If I go ahead and I reverse this, and I certainly don't want to be playing this in a market, I think, that where something's going to move a lot. And we can translate this into a broken wing butterfly. We can translate this into a calendar. We can translate it into anything you want. But it's just something to think about, right? So what if I do the opposite? What if I come in here and I buy these strikes instead? And I have a management thing. I probably don't want to go until expiration day on this unless certain things happen, right? Because I don't necessarily want to lose all my money in the position. It may end up that way, but if I lose that much money, if I lose $1,000, how big of a deal is that if things go really well and I end up making $4,000 or $5,000? It's not really a big deal. So now I don't need my probability anymore. In other words, I can't have a probability of 2% of making money, but if I have a 50-50 shot here and I have a risk-reward ratio like this, that's actually a fairly good strategy if I'm completely non-subjective. If we run this through the year, and we'll go through a couple of examples of maybe some things, right? So day one here, I get an up move of, in this case, well, whatever that is, 35 points. Most of my money is out of this one. This one's worth a lot of money. If I sell it, right, it's like a scalping. If I sell it and I do that, now I'm in this trade where my worst case scenario is I lose 238. And if this thing takes off to the downside, depending on how I manage it, I can make more. If this hadn't moved, I'd probably just exit the trade because because now I'm in the middle of this saddle here. Now I'm relying on this moving a lot coming into the next couple of days in order to remain profitable, right? So I just pull it off and I go down to here. And did I start another one here? I don't remember. Yeah, so then I just start another one here. And I do the same thing, right? So if I go another day, the market doesn't move, right? And I start like 8 days to expiration if I can, right? So then we get a 71 point down move, and I'm up 596, and I pull the trade, and now I have a long on. And the other trade, I don't know if this thing made any money or not with the down move. It did a little bit, right? So we're up money. We're 1 day to expiration. We just closed that out. So we closed out the long on it first. Then we closed out the call. Now we're closing out the put on the next one. So it's active management, right? But it's close to expiration. Now we have this one, and we close out the put here, and we go into, let's see, close out the put. And then we go into our next one, which is here. Something like this. This just happened to be like, I just picked the time period. I just said, I'm just going to do this year. And I'm just going to do this year. And I don't know what the conditions are going to be. I didn't look. My point being is this happens to be good conditions for this type of strategy. It's a volatile market, right? We're getting these fairly aggressive up moves. We're getting these fairly aggressive down moves, or we're trending, right? So one of those things are happening here, and as so long as one of those things are happening, something like this tends to work out really, really well. When we get into this sideways or grinding up market, something like this will lose. If I did this, basically did this process, and I did it for the entire year, I'm going to try and actually, yeah, I have the reports here. It produces something like this. So early in the year when we were volatile, and again, this is with a risk of what, about $1,500 or so. Sometimes, depending on the pricing, it might go to close to $2,000. Sometimes it's maybe a little bit less than that. But for around $1,500 risk in the first short period of 2024, we took $1,500 and essentially turned it into to $15,000. So 10 times gain there. Not bad, right? Then we go through this period where the market's basically, let me see here. So when did this start? This started, so we compare the charting. This is probably towards the middle of end of March, right? So if I have charting and I go to the SPX and I go to like 2024, right? We had some pretty much good aggressiveness here. We get into March here. We see how in the middle of March, see how we start to flatten out. That becomes problematic. We got a little bit of time here where we made a little bit of money. Then here we lost, and then see how sideways we were here. So we had a couple of wins here and there, but mostly losses through this time frame. And then more volatile period here where we come back into wins again. And if you look at this, this is what that produces. Right. So during our volatile times, we kind of would like to be positioned this way. So if we think we're going to be in volatile times, or we realize we're in volatile times, then we can come in and do something like this here. If we realize we're in a more sideways market, I might filter out some of these too. So I have to watch it, but I'd filter out these. Overall, I like this. This is like the inverse of most income traders, right? I build up, I'm a little flat, I build up, and then wham, down a whole bunch of money. And then they go through this whole process again, right? This is the same thing except backwards, right? I bam, lots of money and hit, lots of money, hit. But if I'm going to go into, like I said, if I'm going to go into a period that I believe is volatile, I would rather be in something like this, right? So this has 47% winners in the time frame we did, 52% losers, $37,000 in wins, $22,000 in losses. My winners are outweigh my losers by about 2 times. So I would have to, if these numbers hold out. So one of the things I think about is I would have to win this at least. If it's 2 times, what is it? I have to win it at least 25% of the time. Am I doing my math right, or is it 33? But it's somewhere around. I have to win this at least 30% of the time, probably to break even. My largest win is 8,000, almost 9,000. My largest loss is 1,500. Again, this is almost flipped from income trades, except my win rate is higher than my income trade losing rate generally, and that's that.